Hello, everyone, and thank you for joining us for our webinar today on understanding fairness and solvency opinions. Moving into some housekeeping items. Here are the NASBA requirements you need to fill in order to get your full credit for this session. The requirements are CPE credits will be issued based on a 50-minute hour. In order to receive credit for this course, participants must be logged in for 50 minutes and answer a minimum of 3 polling questions per 50-minute hour. CPE certificates will be issued within 60 days of the completion of this training. Our learning objectives today. Understanding the basic components of a fairness opinion. Understanding the basic components of a solvency opinion. Identifying when a fairness and solvency opinion might be needed. That brings us to our bios. So I am Jerry Collins. I'm a partner at Centri, and I lead the valuation group. I have approximately 25 years of valuation experience at various stages in my career and have been involved with several fairness and solvency opinions throughout that time. I will turn this over to my co-presenter today, Charlie Higgins, to introduce himself.
Great, thanks, Jerry. Hi, I'm Charlie Higgins. I'm a director in the evaluation group at Centri. I have stopped counting my experience at 25 years. I've been involved in a few dozen opinions over those years. I'm also the national practice leader here in our opinion group and our complex financial instrument group. And with that, I will throw it back to Jerry to go into some of the details of fairness opinions and our agenda.
Thank you, Charlie. So our agenda today, fairness opinions. Why? Why is a fairness opinion necessary? We'll get into fairness opinions, definitions, and concepts. Who renders these fairness opinions? The process at which you go through for a fairness opinion, some of our estimated best practices and pitfalls as it relates to fairness opinions, and fairness opinion conclusion. Then we'll jump into solvency opinions and why solvency opinion is necessary, solvency opinion definitions and concepts, 3 key solvency tests needed to be completed, and solvency opinions best practices. All right, so we're going to go into our fairness opinion section now. As we start our fairness opinion, we're going to roll into a polling question.
And the question,
I'm sorry?
This is a tough one.
Yes. Yes. So are you familiar with fairness opinions? And there's 2 answers, yes or no. So please register your answer to the question.
Do they have to answer this correctly to get credit?
Yes. All right.
Probably enough time.
All right. So we gave everyone a chance to answer that. So we're going to jump into why a fairness opinion is necessary. So fairness opinions serve a number of purposes, including to independently validate decision-making of the board of directors, to demonstrate the company's shareholders that the board of directors has taken the necessary steps to make a reasoned proposal to its constituency, and document adherence to the business judgment rule. We'll be defining the business judgment rule a little later in our presentation. So why are they required? They're not required under Delaware law or federal securities laws. Most companies will obtain them in connection with transactions requiring shareholder approval, and many companies will obtain them in connection with transactions of a certain size or significant, i.e. if they're material. So, if you think about it, if it's not material, it's probably not necessary. States often require fairness opinions in connection with nonprofit conversion transactions. Why is a fairness opinion necessary? Here's some examples, and this won't be all of them, but this will encompass a large portion. Corporate acquisitions and divestitures, leverage buyouts, especially management-led leverage buyouts, recapitalizations and restructurings, going private transactions, employee stock ownership plans, ESOPs, transactions, transactions involving insiders or related parties, exchange offer minority buyouts, bankruptcy reorganizations, and nonprofit conversions. Appropriate regardless of whether shares are publicly traded or privately held. Fairness opinions were previously used just by public companies almost exclusively, because compared to private companies, they had a diverse group of owners, a larger size, increased complexity of organizational and deal structures, and increased director liability. That's changed over the last many years. A growing number of private companies are relatively large. They also have a large number of shareholders, which I think is a really important piece of why you're doing this fairness opinion. Lots of different interested parties, which means there's a dissenting shareholders, potential for dissenting shareholders. There's also complex deal structures now with private companies, or they have conflicts of interest between the board and the shareholders. So when do directors obtain fairness opinions? At the time of the board of directors that approves the transaction, when proxy materials are mailed to the shareholders, at the closing of a transaction, where obtaining a fairness opinion for the transaction is a condition of the closing of the deal. Not effective after the fact. These don't help you if you complete one after the transaction is completed. Who generally makes the request for obtaining a fairness opinion? According to the article published in Corporate Board, the decision to obtain a fairness opinion typically originates with one of the following. Corporate attorneys, makes sense, approximately 50%. Chairman of the board, the company's auditors, a major shareholder, a special committee for minority shareholders, or a single director. And I'll turn this over to Charlie to talk about some relevant cases.
Thanks, Jerry. I won't go into a lot of detail on each of the cases, but there is a common theme across them, which is kind of the failure to get an independent analysis of the transaction. In the first case, Smith versus Van Gorkum, the company's board approved a transaction based on a brief oral presentation from the company's president, with no documents presented and no outside analysis. In Hansen, the court was critical of the company's failure to get a written fairness opinion and failure to consider a range of values. The range of values is something we'll talk about a little bit later as well. And then in the final case, Miramar, the court found that the company's failure to honor the request of its outside directors to get a fairness opinion constituted a breach of fiduciary duty on their part. And so now we'll go a little bit more into definitions and concepts of fairness opinions. So, basically, what is a fairness opinion? It's pretty simple. It's a statement from an independent financial expert that the consideration paid or received in a transaction is fair from a financial point of view. Notice in that definition, there's no discussion of the sale process, the allocation of funds, or an indication that the deal is the best possible deal. Why would a board want one? It's pretty straightforward. Getting an outside opinion helps them demonstrate that they did their job in good faith and fulfilled their fiduciary responsibilities. So, as we said before, in one of the cases that the board was criticized for not getting a range of values. So, typically in a fairness opinion, you're going to get a range of values. The bottom end of the range is going to be, theoretically the lowest price somebody would sell for. The top end is going to be, again, theoretically the highest price somebody would be willing to pay. It's not an opinion that it's the best possible price either for the buyer or the seller, just that it's a reasonable range. This is really important here. Opinions are obtained to assist the board. They're not advice to the shareholders. An opinion is not intended to bless the deal, recommend the deal, or provide shareholders, a reason to vote in favor or against the deal. It's for the benefit of the board to show that they've done, fulfilled their responsibility as board members and fulfilled their fiduciary responsibility. As mentioned, one of the cases mentioned before, Smith versus Van Gorum, also as part of that case, they made it clear that the court found, that it's for the benefit of the board, not for the shareholders. And moving on to, just some more kind of definitions and concepts. The purpose of a fairness opinion is not to look at the relative merits of the transaction or the process. Again, it really just goes into, is the total consideration fair from a financial point of view? When there's stock involved, the value of the stock that's considered is, the value of it on that day. The opinion doesn't address whether the value of those shares will increase or decrease in the future. It's as of the date of the transaction. Again, fairness opinions are directed to the company's board of directors. It's not for their shareholders. In a lot of cases, the board will put together a special committee of board members specifically constructed to address that transaction. Obviously, a best practice would be to have members of that committee include some of the outside directors. And also, a fairness opinion is typically not going to look at how the proceeds from the transaction are allocated. And this gets talked about a little bit as well in the next slide. So as we said, if you have multiple classes of equity that are going to be receiving the proceeds, an opinion is not going to address, specifically the preferred stock. They'll tend to have a lot of different bells and whistles associated with them that may result in preferred members, in some people's view, potentially getting a disproportionate percentage of the proceeds. That's not the purpose of a fairness opinion. Again, a fairness opinion is just going to look at the total proceeds and whether they're within a reasonable range. They also don't address any other of the other terms of the transaction. So if there's severance agreements involved and lockups, that's outside the purview of a fairness opinion. Again, they're from a financial point of view, not is this a good thing for the company to engage in this transaction or not. It's all about the numbers. And even though opinions help to help the board fulfill their responsibility and demonstrate that they've exercised the business judgment role, it's not a substitute for that. They still need to do their job. And as Jerry mentioned before, an opinion after the transaction isn't going to be very helpful. You will sometimes see opinions that are rendered after the transaction, usually from the side that thinks the transaction was not a good thing, and litigation's involved, and they'll get a not fairness opinion, if you will. And this is what a fairness opinion is and is not is equally important. Again, it's not a fiduciary or legal opinion. It's not addressed to the shareholders. It's not a solvency opinion. There's no guarantee that investors are going to get a certain return as a result of the transaction. It's not a guarantee that the company's not going to go bankrupt. And it's also not a substitute for the board and management doing their job. It's just to assist them in the process of doing their job. And that takes us to our next polling question, which I think it's probably a little bit harder than the prior one, but not too difficult. So, fairness opinions are addressed to A, the company's lenders, B, the company's board of directors, C, the company's shareholders, or D, the company's auditors? I think we may have answered this question for everybody, a couple of times already. So we'll see who was paying attention. And yeah, looks like some answers are coming in. Not everybody yet, so we'll give it maybe 15 more seconds or so. Okay. And the correct answer is B, the company's board of directors. Again, a fairness opinion assists the company's board of directors in making an informed decision regarding the transaction. It's not intended to be for shareholders or anybody else. It's just a tool for the board to help them in their decision-making process. And with that, I'm going to hand it back over to Jerry, who's going to talk about the folks who typically will provide fairness opinions.
Thank you, Charlie. So now we're going to get into who renders fairness opinions. And historically, most fairness opinions have been written by investment bankers. Obviously, it kind of makes sense. They're going to be very close to the deals as they're most likely involved within those deals. In addition, other authors include valuation consultants, like Charlie and myself, commercial banks, and CPA firms. Okay, so some issues. The following issues should be investigated prior to engaging a financial expert. You want to understand objectivity and independence. I think it's pretty self-evident why that's important. You want to have a fair and independent analysis. You also want to make sure about resources. Do they have enough staff? Do the appropriate research, and then there could even be additional requests as far as resources, maybe like database is allowed or that they have access to. Could also be a prudent need. Also, financial expertise, transactional expertise makes a lot of sense. Litigation experience. Nobody wants to see a deal go bad, but in the case that they do, litigation expertise is often helpful in that space. And then, of course, reputation. Conflict issues. Conflicts generally don't prohibit, but need to be managed. So if there is a conflict, if there's a relationship, on most situations, there's going to be some kind of at least relationship. So you just want to understand those conflicts and make sure that they can be managed. Typical issues: contingent payments. That's always a hot button issue. If you complete this and the deal goes through, then we'll pay you. Maybe not the best situation. Deal maker. Investment banker is also a fairness opinion provider. Again, we've talked about that, whether there's some independence there, if that may be of issue as well. So we're going to switch over to the fairness opinion process, and I will turn this back over to Charlie.
Great, thanks, Jerry. So yeah, as we get into the process of a fairness opinion, everything starts with the engagement letter. Unlike what most people would experience in kind of a typical evaluation, if you will, or appraisal, the engagement letter process is much more involved. In our practice, we actually do utilize outside counsel in helping us to construct the engagement letter. That counsel has significant interaction with the client's counsel as well, to make sure that the terms of the letter are satisfactory to everybody. The wording of the letter is correct. Commas are where they're supposed to be. So it's actually quite an involved process. And also as part of the engagement letter process, you start to build out some of the other parts of the overall process. You're getting a sense for the transaction. You're defining exactly what fairness is and fairness to whom. That's also when, the information gathering and the due diligence process starts. You know, fairness opinions are a combination of evaluation exercise and, also a due diligence exercise. So there's a lot that goes into the process, and that starts right from the beginning. Some of the other things early on in the process is, obviously you're providing a fairness opinion, but, is there also maybe a pricing memorandum needed in connection with the transaction? Again, you want to define very specifically to whom the opinion is directed. As we've said a few times, it's generally going to be the board of directors or even better, a special committee. We'll talk about this next item a little bit as well, but, are you going to have enough time? The timing of the opinion is going to be part of the engagement letter. What's available from a projection perspective, and you want to make sure that you're not getting into a relative fairness situation. As we talked about before, the fairness opinion is typically not going to address allocation of proceeds. So that's where you start to get fair to this group as opposed to fair to that group within a company. And with that, we'll move on to some best practices to help in the process. Again, one of the things we've talked about a few times is independence. As Jerry mentioned before, opinions have historically, most often been provided by the investment banker, who's actually, doing the deal for the company, getting a huge payment. Obviously, the rest of their payment is going to be dependent upon the deal closing. So, they have a vested interest in having the deal close. So, is their fairness opinion really going to be independent? As transaction activity increases, you get a lot of parties involved. You start to get a lot more potential conflicts of interest. And again, as Jerry mentioned, having a potential conflict or perceived conflict is not necessarily a deal killer, if you will, but it does need to be disclosed, and everybody needs to be comfortable with it. Companies are work with each other all the time. Advisors work with their clients all the time. So just having an existing relationship in place is not something that necessarily means that they can't provide an independent analysis. And then just bringing up a few more cases. Again, I'm not going to go into tons of detail on each of these, but in the first one, we talked about timing. In Weinberger, the preparer had 3 days, which in this case, the court decided was really not sufficient time. In our experience, and talking with the different law firms that do a lot of transactions, kind of our rule of thumb is you got to have at least 2 weeks really to do a thorough job and fulfill your responsibility as an expert. In the next case here, Norte, there was bad information provided. So, in a garbage in, garbage out kind of situation, if the company's not providing good information, it's very difficult for the advisor to provide an effective and then therefore valid opinion. Similarly, in Shell Oil, the company actually withheld information that would have been, material to the analysis, which makes the analysis, essentially invalid at that point. In Halo, there were a couple different sets of projections available, one that was provided by the company, one that was provided by an outside firm. And, in this case, the court ruled that, the provider, CS First Boston, correctly relied on company management's projections because that was what was agreed to in the terms of the engagement letter. And also in Halo, which is a pretty important case in terms of opinions, it laid out very clearly that the opinion is as of the date of the transaction. So in this case, the .coms started to crater very shortly after the transaction, but the court ruled in favor of CS First Boston, that their opinion was rendered prior to that, and it's not subject to implications of what happened after the opinion was granted. And then in Madden, really just gets down to how important the engagement letter is, and clearly stating who the opinion is addressed to, so that other parties don't feel that they're able to benefit from the analysis. And so then, does the expert's work product adequately describe the analysis in reasonable detail? In one of the earlier cases we mentioned, Smith versus Van Gorkum, it was made clear that the court did not look favorably upon the fact that a transaction was approved, just simply based on a 20-minute presentation from the company's president. When the board approves a transaction, they really have to know what was done in the analysis for the fairness opinion. So again, not going to get into great detail on the different cases here and whatnot, but as a fairness opinion provider, solvency opinion provider, you need to give the board enough information so that they understand what the analysis was, make sure they understand it, have the ability to question some of the assumptions that are in there. And if it's simply a 2-page letter with no discussion of the underlying analyses, or no presentation to the board going into detail on the analyses, the opinion's really not going to be all that valuable. And with that, I'll turn it back over to Jerry to wrap up our fairness opinion discussion.
So fairness opinion conclusions. So while not mandated by law, it is in the best interest of the company's board of directors to obtain a fairness opinion. It makes perfect sense, right? You're getting an independent party to, come down with a conclusion whether it's fair or not. Definitely beneficial for the individual shareholders to cover the board. Care must be taken in the selection of the financial expert. Make sure that, as we've kind of talked about prior, there's a checklist you want to make sure about. Expertise, independence, those types of categories are important. Fairness opinions should conform to the best practices. In addition, of particular concern in the current business environment is the potential for a conflict of interest, either real or perceived. And then a fairness opinion is both a valuation and a documentation exercise. And with that, we've concluded fairness opinions. We'll roll right into the solvency opinions. And our next slide is, why is a solvency opinion necessary? So we'll give you some examples of when a solvency opinion is appropriate. You have your levered dividend recapitalizations, other levered transactions like levered buyouts and management buyouts, restructurings of debt refinancing, spinoffs, dividends, and share buybacks. So solvency opinions are generally not required, but have evolved from state corporate laws requiring boards to approve transactions affecting shareholders and laws preventing fraudulent transfers. Again, it's to protect those who are shareholders, to understand where these deals have some potential to come out. Independent solvency opinion mitigates the risk of future fraudulent conveyance claims. Lenders often will provide funding on more acceptable terms if a borrower obtains a solvency opinion. Types of beneficiaries include board of directors of a company, unsecured creditors, secured creditors, stockholders, and financial advisors. So the reliance on a solvency opinion has grown significantly with the increase in the number of leveraged buyouts and dividend recapitalizations. As leveraged transactions have increased, so have the number of subsequent reorganizations, liquidations, which potentially injure both pre-transaction and post-transaction creditors. Independent financial consultants will perform a solvency analysis to determine whether, following some of the leverage transaction, the company that incurred the leverage is left with positive equity, the ability to repay its debts as they come due, and adequate capital to operate the business. Solvency opinions serve a number of purposes, including to independently validate a decision made by the board of directors and to demonstrate that the company shareholders that the board of directors has taken the necessary steps to make a reasonable proposal to its constituency. Just again, to make sure that these follow the parameters to allow the business to continue and have capital, enough capital. So we'll move on to why solvency opinion is necessary. Based on the business judgment rule, presumes that the directors are acting properly if they act. And again, this is what we've kind of presented earlier in our presentation. So on an informed basis, in good faith, in a manner they reasonably believe to be in the best interest of the stockholders, and without fraud or self-dealing. Compliance with the business judgment rule is suggestive of compliance with the fiduciary's duty of care, which is directors are required to perform their duties with the same level of care that an ordinary prudent person in a similar position would use under similar circumstances. So who may request a solvency opinion? The directors of a company to prevent claims for breach of fiduciary duty and reasonable care. The lender of the transaction, prevent litigation in the future and mitigate risk of claims on consideration received. Plaintiffs or defendants counsel in a subsequent legal action, usually analysis as of a past date concurrent with the transaction. And with that, we will move into our polling question.
Okay, and I think that's back to me.
Mm-hmm.
So, polling question number 3. Solvency opinions are often requested in connection with A, levered transactions, B, spin-offs, C, stock issuances, D, A and B. And while we wait for people to get their answers in on that, I would just add on the prior slide. Jerry, earlier we talked about who requests fairness opinions. In my experience on solvency opinions, in most of the cases, it's again the company's attorneys recommending to management and the board that they get a solvency opinion done.
Yeah, and that's kind of when I've seen that as well.
All right, so looks like we're getting a fair number of responses in. Give it a few more seconds. Okay, I think we're good. And the correct answer is A and B. So levered transactions and spin-offs. And that's because they could both potentially negatively affect the company's ability to service its debt and remain solvent. Stock issuances aren't really a cash flow item, so you're not typically going to see a solvency opinion in connection with stock issuances. And with that, we'll move into again the definitions and concepts of solvency opinions. There are quite a few similarities between solvency opinions and fairness opinions, at least at the outset. But then there are a fair number of differences as well. So first point is what is a solvency opinion? And it's pretty simple. It's a statement from an independent financial expert that assures the directors and or lender, if that happens to be the client, that the leverage transaction is not likely to harm other creditors by forcing a bankruptcy or liquidation, A solvency letter expresses an independent expert's opinion on the borrower's ability to remain solvent under the burden of the additional liability to pay its debts as they mature and to continue operations as a going concern in changing economic environments. And it's like a fairness opinion. It's typically in the form of a letter to the board. But again, like a fairness opinion, it's best practice that it not just be a simple letter saying, okay, here are the tests and you pass. There needs to be, the board needs to have the benefit of seeing the analysis that goes into that opinion. In our practice, it's generally an additional presentation to the board that goes into great detail on exactly, what was done as part of the generating the opinion. And with that, we'll get into the three typical tests. There actually can be some more, but these tests come out of the Uniform Fraudulent Conveyance Act, basically checking conveyances by an insolvent, conveyances by a person about to incur debts, and conveyance made with the intent to defraud. Okay, so the first test, and again, to kind of pass the solvency opinion, regardless of whether it's 2 tests, 3 tests, 4 tests, 5 tests, the company needs to pass all of them. So it's not, if it's a 3 test and you get 2 out of 3, you're not going to get a positive opinion from your provider. But the first test, the balance sheet test, and this is done at the time that the transaction occurs. In the instance of a dividend recap, the company borrows money and then they issue themselves the dividend. So you're going to want the opinion at the time that happens. Typically when the dividend itself is issued. And basically the balance sheet test determines if the company's assets are greater than its liabilities, assuming that the transaction has occurred. The assets of the company are valued on a going concern basis using typical valuation methodologies, discounted cash flow, M&A transactions, public company multiples, and then you compare that to the company's liabilities, including any contingent liabilities. And in this case, in most cases here, the definition of fair value is pretty important. It's the amount at which an asset or a liability could be bought or incurred or sold or settled in a current transaction between willing parties other than in a forced or liquidation sale. And the balance sheet test is passed if the sum of the company's assets are greater than its liabilities, including any contingent liabilities. And this is, very, very brief summary of what, kind of the conclusion of a balance sheet test is going to look like in the presentation to the board. So you see the red line toward the left of the graph there. That's the total liabilities that the company will have after they borrow the additional money. In this case, it's $22 million. To the right, you see those blue boxes. Those are the conclusions from each of the valuation methodologies used in this particular case. So that the DCF had the value of the company, mid 50s into low 60s. Relevant M&A transactions, were in the low 60s, and then applying public company multiples to the company's metrics had them in the mid 50s. So all those value indications were well to the right of the red line, which would indicate that the company is passing the balance sheet test. And in this case, with a pretty comfortable cushion. So, as the board is considering the transaction, they're viewing the results of this test, they can be pretty comfortable, that the value of the company is quite a bit higher than what the liabilities would be, to aid them in making their decision. As those, blue boxes, if they started to move to the left or, even left of that red line, that's when you get in danger of not being able to say the balance sheet test is passed. And then the next test we'll talk about is the cash flow test. This is just showing, a company is incurring debts that would be beyond its ability to pay them as they mature. Conclusions about the ability to pay debts are based on an analysis of the projected future financial performance of the business. Basically it's projected cash flows. And, in the cash flow test, future debt payments are computed and scheduled by due date, including, any that result from the new debt that's being taken on. And you have to look at the liquidity of the company going forward. And, to be able to calculate the available liquidity, you need to consider, excess cash, additional borrowing capability, maybe under a revolver, something like that. And then just cash flow earned in each of the respective periods. And in this case, the company will pass pretty simply if in each of the periods examined, it has positive cash essentially at the end of each of those periods. And again, that cash can come either through cash that's already on the balance sheet, cash that's generated by operations during that period, or the company's ability to maybe pull down some temporary debt to fill in any timing gaps. And in this slide, this is typically what you're going to see as a cash flow test in a solvency opinion. It's essentially the company's projected cash flow statement or statement of cash flows. And in each period, you see, through a combination of cash they already had, cash generated by operations, or drawing down on a revolver, the company is expected to be able to maintain a positive cash balance throughout the projection period. And so in this case, they would have passed the cash flow test. The next test we talk about is the capital adequacy test. In the capital adequacy test, what you're trying to measure here is essentially that the company is going to be able to continue to operate as a going concern, the way it normally does. There's a few different ways that you would look at adequacy, capital adequacy. It's not as well defined, if you will, as perhaps the balance sheet and the cash flow tests are. But generally, analysis is going to determine whether the company would exceed its debt covenants, and also kind of compare the capital of the company to some other industry participants. So in these next couple slides, what we're looking at here is kind of a typical capital adequacy test. So in this particular case, the debt that the company took on did have some financial covenants. So they had a maximum average leverage metric in there, and they had a fixed charge coverage ratio in there. And the keys to look at here are the calculation of each of those measures in each period. In this particular case, those covenants were on a quarterly basis, so the test was done on a quarterly basis. And in each period, in each of those metrics, they were above or below, depending on whether it was a max or a min allowed. Another important thing that's included in this test, again, in addition to rendering a positive opinion, the point of the analysis is to help the company's board in assessing the transaction. So the cushion for each of the periods is provided, which is important. As we talked about with the balance sheet test example, the values were well in excess of the company's liabilities. Certainly that gives the board a lot more comfort in the conclusion of the test and deciding whether to move forward or not. Similarly here, the cushions are pretty strong. That gives the board that additional information. If those cushions were much smaller, even though passing, that could give the board a little bit of pause. And then this next slide Most of it just goes into additional periods of the same tests. But down at the bottom, you can see, we're also looking at, what the capital cushion is, or, so what's the difference of the fair value of the total assets, less the liabilities over the liabilities, compare that to some of the public companies operating in the same industry. And, as long as, our company, the client is, within that range or above the range, even better. It gives the board some sense of comfort, and you pass that capital adequacy test. But pretty simply, a solvency opinion, the three tests are really just looking at, is the company going to be able to pay its debts? Is it going to have cash flow? Does it have adequate capital? Is the value of the company greater than the liabilities that will be present after the transaction occurs, after the additional debt is taken on? Sometimes there will be one or two additional tests depending on the state. Capital surplus is probably the most common. It's very similar to the balance sheet test. Basically, in addition to the liabilities, it adds in the par value of the company's stock. Which tests are appropriate, which tests are needed is, something that gets agreed to at the start, as part of the engagement letter process. And then so we'll move on to a few best practices. A lot of these are very similar to what we talked about with the fairness opinions. Again, you want an independent expert providing this. Again, it doesn't mean there can't be a relationship between the advisor and the company. I think with the possible exception of one going private fairness opinion, every opinion I've been involved in, we had a working relationship with the client. That's why they came to us. They knew our work, they trusted our work. But the company, the provider, has to do the work. It's not a rubber stamp. Lots on the line for the provider, particularly in a solvency opinion. So you need to do a good job. Again, the purpose is to provide information to the board, whether it be a fairness or solvency opinion, that they can use in their decision-making process. So you need to do a good job with that. As was pointed out in some of the cases, to do a good job, you need to have time. Again, the kind of rule of thumb that we've operated under is at least a couple of weeks. And you need to provide documentation. While you could sort of satisfy the letter of the law with a simple 1 or 2 page letter, you're not really doing your client a service with a deliverable that simple. You need to give them the opportunity to see what you did, probe it, ask questions, agree or disagree with some of the assumptions, and see what the implications of maybe those disagreements might imply. And to kind of start to wrap things up, solvency opinion, again, it's in the best interest of the board to get one. They need to select a provider who knows what they're doing, has ability to do their work independently, has good processes in place, and again, potential conflicts are important, but as long as they're divulged and the expert truly can operate independently, having an existing relationship is not an issue. It can be a benefit, and as with fairness opinions, it's a mix of evaluation and documentation. Perhaps the cash flow test and the capital adequacy test are a little divergent from what most valuation experts are going to see or do on a regular basis. So that's where it is important, to engage an expert that has experience providing opinions and understands the differences between an opinion and a traditional valuation. And just to wrap up, solvency opinions, as was talked about in one of the cases, if you don't have good information going into the process, your result's not going to be as good as it could be. You really need to provide a diligent analysis. If there are specific factors to the company that need to be addressed, obviously you have to do that. And, you have to understand why the transaction is being done, how the structure works, how the funds are going to flow. We'll typically or very often see, particularly in a dividend recap situation, multiple layers involved. You've got a top co, a mid co, and an op co. Where's the money being borrowed? How's it getting from one entity to the other? Which can also, in a lot of cases, require each of those entities to get a solvency opinion. And again, it's not a guarantee. Company could still go bankrupt. Hopefully not, but it's a good faith analysis. And that brings us to our final polling question. A solvency opinion is not A, a reason for the board to do less due diligence, B, a risk mitigation cure-all, C, a guarantee or insurance policy, or D, all of the above. Give everybody just a few seconds to answer that.
We got some answers coming in.
All right. And I think we're closing in, or if not just at our required time. So
good.
Everybody with answering 3 of the 4 questions at least should be able to get their credits. And so let's see. D, all of the above. Again, a solvency opinion expresses an independent expert's opinion on a borrower's ability to remain solvent under the burden of additional liability, to pay its debts as they mature, to continue operating, as it has operated or is intended to operate. But, the board still has to do its job. They still have to exercise business judgment, consider the transaction carefully. The solvency opinion is one piece of information for them in that decision-making process. It's not the process itself. So it's not a get out of jail free card for them. And with that, we have concluded our presentation. So Jerry, thanks very much for helping me out with this, or working with me on this. I don't know if you had any closing comments, or if we want to just wrap it up.
No, I'm again, hope everyone found this useful. If there's any questions, feel free to reach out to either Charlie or myself. I think you have our contact information in front of you right now. Always happy to have a conversation. Always happy to answer any questions. And I think with that, we'd just like to say thank you.
Yeah, thanks everybody. Thanks for giving us an hour or so of your afternoon, and have a great day.